Good afternoon, everyone, and thanks for joining us for today's live event, which forms part of our month-long ISA series, in which we're welcoming some of the leading fund managers in the industry. Today, I'm joined by Craig Baker, Chair of the Alliance Witan Investment Committee, and he'll be talking us through the trust and what it offers investors looking for a core global fund for their ISA. As one of the oldest and also the largest trusts, Alliance Witan probably needs little introduction, but here's a few highlights. It provides a one-stop shop for global equities with a select group of fund managers asked to submit up to 20 of their best ideas. It's been promoted to the FTSE 100 after its recent merger, and it's also joint top of the AIC Dividend Hero leaderboard with 58 years of dividend increases. And that's enough for me. So Craig's going to start proceedings with a 25-minute or so presentation on the trust. We'll then have 15 to 20 minutes for Q&As. So if you have any questions, please do put them in the Q&A box at the bottom right of your screen. We'll try to get through as many as we can in the time. And without further ado, over to you, Craig.
Terrific. Thanks very much. Good afternoon, everyone. It's fantastic to get an opportunity to talk to everyone. So as was said, my name's Craig Baker. I've chaired the investment committee at Alliance Witan, or Alliance Trust, as it was previously, for the last 8 years. And I'll go through in a bit more detail what we do and the like. But for those that don't know Alliance Witan in any detail, as said, we're a global equity investment trust that's managed on a multi-manager basis. And that's been true since April 2017, when we took over running the portfolio. In other words, we do all of the work for you. We find who we think are the world's best stock pickers. We then ask them to run a separate account specifically for Alliance Witan that's made up of only their very best ideas. And I'll go through that in a little bit more detail as we go through. We then decide how much to give to each of those stock pickers that we've chosen from all around the world, in order that we're managing risk at the total portfolio level to an appropriate level. We then regularly rebalance between those managers, rather than you having to do it yourselves if you were invested in a number of different investment trusts with different managers. It's also got the advantage that that's all done within the wrapper, and so you're not incurring capital gains tax, for example, when selling the product that's done particularly well, for example, to rebalance across the managers. And then we also will replace any of the stock pickers at any point in time if we think they're no longer well placed to add value to the trust. And so that's what we, the team at WTW, who I'll introduce you to in a bit, do. I chair the investment committee of people from WTW that run this on a day-to-day basis. So, as mentioned, this used to be Alliance Trust, was the name that it has been there for over 100 years. But in October, just gone, we actually did a combination with Witan Investment Trust. Now that's carried on following exactly the same process that Alliance Trust has had since, as I said, we took over 8 years ago. But the background was that Witan Investment Trust also managed a multi-manager approach, but with a small internal team. In March last year, Andrew Bell, the CEO of Witan, announced that he'd be retiring, and that triggered a formal review by the board of Witan Investment Trust. They got 50 plus approaches from different asset managers suggesting that they could take over Witan Investment Trust. Alliance Trust was one of those that suggested actually we could form a combination for an even more powerful multi-manager approach with the combined entity. And that ultimately was the one that won a very competitive process that went on through the months through to October, when we formally combined. At the time, we proposed that we would do all of the things on here. So first of all, one of the big advantages of this was the continuity of the approach. For the Witan shareholders, there was the continuity of the multi-manager approach. For the Alliance Trust shareholders, there was continuity of almost everything. The team unchanged, and the underlying stock pick is relatively unchanged. And I'll go through some minor tweaks that we made to the portfolio because we had the opportunity. The other big advantage of this was to be able to bring down costs. So the OCR on the new Alliance Witan is a lot lower than it was for Witan shareholders, and a bit lower than it was for Alliance Trust shareholders because of the bigger scale. And linked to that, because the assets are over £5 billion in assets now, we actually entered the FTSE 100 in December, the first rebalance after the combination of the two entities, and that's helped increase liquidity in the portfolio for investors. So there's a lot more liquidity in the shares of Alliance Witan than there would have been in either Alliance Trust or Witan Investment Trust prior to that. We did that at the same time as increasing dividends. So it's an increase of about 6% in the dividend 2024 relative to 2023 for Alliance Trust investors, and about a 4% increase for Witan investors. And we did that with no NAV dilution at all. So all the costs of the transition were paid for by a fee waiver on the new assets by us, WTW, and the underlying stock pickers for a period of time, in order to ensure that there was no cost going to shareholders, be that Alliance Trust or Witan shareholders, and then ultimately making it a higher profile trust, which we think has led to this being kind of a one-stop shop that could be at the heart of every ISA or pension portfolio for any investors that are out there. So that was the plan. Now, what hasn't changed, as I said, is the approach that has been in place for some time. This remains the objective of the trust. You can see there, it's to deliver a real return over the long term through a combination of capital growth and a rising dividend. Importantly, we think that if we achieve that, then we will comfortably beat the benchmark, which is the MSCI All Country World Index, and the peer groups. And we look at both the peer group of other global equity investment trusts and also the wider peer group, Morningstar peer group, that includes open-ended funds as well as closed-ended funds. So over the long term, we're comfortable that achieving this objective will also beat those particular benchmarks as well. Now, just to introduce you to WTW, which is the group that manage Alliance Witan on a day-to-day basis. We're probably one of the largest firms you've never heard of, so about 45,000 people at WTW, but about 1,000 of those, 980, as you can see here, focused on investment. And we typically advise and manage assets for large institutional investors. And when we took over running Alliance Trust some 8 years ago, the idea was to bring best practice of what's done in the institutional space to the UK retail space for the first time. And so this multi-manager approach that I'll talk about is something that we've been doing for a long time in the institutional space. And we've got significant resources there, very large research team going out and finding the best stock pickers in the world, and a very large portfolio management team and back office team in terms of how to construct portfolios on a multi-manager basis as well. These are the three key individuals in terms of the day-to-day decision making on what we do in the portfolio. That's both picking the managers, replacing them if needed, but also rebalancing, thinking about risk and the like in the portfolio. And so the three of us have all worked together for more than 20 years. We've been running institutional portfolios on exactly the same basis as we've been doing here for 8 years. We've been doing that for nearer 20 years in the institutional space. But we have also got the advantage of some of the team, well, all of the team apart from the CEO that was retiring from Witan, have come across as well. And so James Hart is someone that some of you may know from his time at Witan, and he comes to all of those investment committee meetings now as well. I just flip on to the next page. This tries to summarize essentially what we think is the difference in the Alliance Witan approach compared to others. And essentially, it's a multi-manager portfolio with a difference. So we asked the world's best stock pickers to just give us their 20 best ideas. It can be less than 20, but not more than 20. And we do that in them giving us a separate account managed specifically for Alliance Witan. We then blend those managers in a way that ensures stock selection drives everything. So we don't want big country positions. We don't want big industry positions. We don't want big style biases. We don't think that's the most efficient way to add value. We really want stock selection to drive everything. Now, one of the problems of most multi-manager approaches, whilst they give you all the benefits of reducing the risk to one stock picker, getting rid of style biases, allowing stock selection to drive things, they tend to have two issues. One is that it can end up quite expensive because of the double layer of fees, and the other is that they can potentially end up over diversified, so that it's actually quite difficult to significantly outperform. Well, we've tried to address both of those issues. The first on costs, because we've got that huge depth of resources and huge assets that we advise on and manage across our institutional client base, some 4 trillion on the advisory side and close to a couple of 100 billion on the discretionary basis that we manage. We are able to negotiate much better fees with the underlying managers, and hence this comes out with a total expense ratio on this investment trust that's lower than you see on many single manager approaches, at less than 0.6% per annum, with everything taken into account: our fees, the underlying manager fees, the costs of running the trust as a whole. And then that second point of potential for over diversification, we address via this only taking the manager's 20 best ideas. So why only 20 best ideas, apart from this theoretical keeping it not over diversified? The other reason is that there's a lot of academic evidence. We've also got practical evidence of this, but there's a lot of academic evidence out there that that is the best way to add value. So whilst if you take all of the active managers out there in equity space, on average they perform in line with the index before fees and worse than the index after fees. Interestingly, the vast majority of them outperform in their largest 10, 20 overweight positions, and then tend to destroy value in the rest of the portfolio. And the reason for that is that they can only know and have a real edge in their very best ideas. There's only so many they can cover, and then they're holding a lot of stocks for risk management purposes that they haven't got a strong view on, but they can't run a highly concentrated portfolio because it'll be incredibly volatile, and so they'll put fillers into the portfolio to manage risk. And then, unsurprisingly, in an efficient market, those don't add any value on average. In fact, they slightly destroy value on average because of that efficient market point. What we do instead is say, well, just give us your very best ideas and we'll worry about risk management in terms of how we blend those managers. So in our portfolio, there's no stock that's held for risk control purposes. Every single stock that's in there is someone's very best idea. And we manage risk through just having managers that think very differently being combined in the portfolio. So that's kind of why we think the 20 stock approach works within multi-manager. But there's an obvious question of, why does multi-manager work? Why is that a particularly attractive proposition? And what we've shown here is a chart that I think is really very powerful. I'll have to explain exactly what it is. So what we show here is for each line that says, let's take all of the managers in a particular 3-year period that were top quartile in that 3-year period. And then we say, what's the probability that they're top quartile in the next 3-year period after that? And then what's the probability that they're still top quartile in the 3-year period after that, and so on and so forth. So if you take on the left-hand side, you'll see that in that period 2003 to 2005, we've taken the ones that were top quartile then, and then we've said what proportion of them were top quartile in 2006 to 2008. Well, it was about 30% of them. And then what proportion of those was still top quartile in 2009 to 2011? Suddenly it falls to about 3% of them and gradually goes down to zero. But more interestingly, if you go right the way across to the right-hand side, you'll see that in more recent times, when we've had more volatility and more style-driven type markets, it almost goes to zero immediately, that it's been almost impossible for a manager to be top quartile in 2-3 year periods in a row. Now, the whole idea of multi-manager is that what you can do is you can blend managers that are very different, such that you can continue to produce consistent, good results over rolling 3-year periods, rather than being the best that's out there, then the worst that's out there, because you've got a single style. So for us, what this shows is that every retail investor on this call should be doing multi-manager. It's just a question of whether you want to try and do it yourself and invest in multiple different investment trusts or open-ended funds run by different asset managers, or whether you want to have someone that does this as a day job do it for you within a wrapper, so that it's actually more tax efficient and the like, and we can do it getting lower fees with the underlying managers than you could get doing it yourself. So that's kind of the principle behind why we think the approach that we've got at Alliance Witan is particularly attractive for the retail investor. Now, here's the kind of funnel that we show as to how we get to the managers that are in the portfolio, and I'm going to walk you through who the managers are, but there are 11 different stock pickers that we have within the Alliance Witan portfolio, and you can see that comes from us doing work on 12,500 equity managers. So we get a huge amount of information on thousands of products that are out there. We do all sorts of desk-based research that then feeds into the ones that we want to go in and do formal research meetings with, where our researchers will go in and spend a few hours with the manager. They'll sit at their desk, go through stock examples, see the valuation models they've created on the stocks. They might sit in on their internal meetings. They might even sit in on a meeting they have with a company to see the kind of questions they're asking, really trying to probe what is it that makes that asset manager, that stock picker, better than the others that are out there. From that, we get to about 180 managers that we think are really top quality running equities. That's across multiple asset classes, so global equities, US equities, European equities, so on and so forth. And then it's from that that we find about 22 currently, but somewhere between 20 25 is fairly typical, managers that we think are not only highly skilled, but they're particularly skilled at running these really concentrated 20 stock best idea portfolios. And it's from that that we then select 11 of them that blend quite nicely to create the portfolio for Alliance Witan. But it means that at any point in time, if we needed to replace one of those 11 managers, we've got that other 11 managers out of the 22 on the bench ready to go into the portfolio. And indeed, many of those are in some of our institutional portfolios. So we've been invested with them for a number of years and have seen how they perform in different environments. On the right hand side, we actually explain the kind of things that we're looking for in the managers we research, but that's where we've got this team of about 80 manager researchers that are constantly going out and researching investment managers around the world in order to choose who are the best ones to be in this lineup and other portfolios that we manage. So next question is obviously, well, where does that leave you? What does the portfolio look like today? And what I've shown here is the manager lineup, the stock pickers that are in the portfolio as of today. So what you'll see first of all is that there are 11 managers and actually 12 portfolios. So the eagle-eyed amongst you will notice that GQG there has got 2 segments, one at 13%, one at 6%. All of the managers, including GQG, run this best ideas, go anywhere, maximum of 20 stocks, and they can go into developed markets, emerging markets. But in addition, we asked GQG to run a specialist emerging market portfolio that's got a few more than 20 stocks. That's the 6% slug. And the reason is quite simply, if you just ask people to go anywhere, 20 stock portfolios, you tend to end up with a slight underweight strategic position to emerging markets because people feel a bit more comfortable putting, say, 5% in a developed market stock than they do in emerging market stock. You get some emerging market companies from each of the managers, but we just make sure that we haven't got a strategic bias away from emerging markets. So that's why there's 12 portfolios rather than 11. The other thing I'd note on here is that you may not recognize all of the names on here unless you've seen Alliance Trust stuff or Alliance Witan stuff over the years. That's because some of these managers can't actually be accessed in UK retail space in any way other than Alliance Witan. And even those that can be accessed in directly in UK retail space, you can't get access to just their 20 best ideas. And typically you'd be paying higher fees than you are for Alliance Witan, even though Alliance Witan has WTW doing the multi-manager piece on top. So that's an important point to make. And then the other point I'd make is that by design, we've put in place different stock pickers that think about the world very differently. So here we've got a blend of managers that are a bit more growth oriented, managers that are a bit more value oriented, some that are more large cap, some are more small cap, some that are very global, some that tend to focus more on the US. There's quite a mix. But even within that, they can be quite different in a certain label. So just as an example, Vulcan and Lyrical on here are two managers that will both say they're a value manager. They'll both focus almost entirely on the US, and yet there's almost zero overlap in their portfolios. And that's because Lyricals start with a view of let's look at the cheapest 20% of companies in the world and then try and find within that who are going to be the winners and have unfairly had their share price fall too much. Whereas Vulcan would start very differently. They'd say, well, let's look for the truly great companies in the world, think that the kind of way Warren Buffett would think about the world, things that we're happy owning for the next 10 years if the stock market closed down. And then within that universe, we'll only invest in any of those stocks when we think they're trading at a very significant discount to intrinsic value. So both are looking for cheap companies, but they've started with a very different universe before they've got to the end point. And so even though they claim to be quite similar in their labels, they actually look like nothing like each other in terms of the portfolios. Now, some of the managers have been in that portfolio since the inception of us running it in 2017, but others have come in more recently. And so I've just got a couple of examples that have come in 2024. So Jennison actually was a manager that was in Witan's portfolio, wasn't in Alliance Trust portfolio. We at WTW have known Jennison for many years, like them a lot. They're actually in some of our institutional portfolios and have been for a number of years. We took the opportunity to bring them into the portfolio because we could do it at zero cost. We just brought the stock across in specie as the Witan assets came across. So it's just a good opportunity to bring in a really high quality growth manager, a bit different to some of the other managers that we had in the growth space, like Sands Capital in our portfolio. Another manager that came in at the same time was EdgePoint. Now, they weren't in Witan's portfolio or Alliance Trust portfolio, but because we were doing the transition and using a transition manager and keeping all the costs very low, we thought at the same time we would make a business as usual change, bringing EdgePoint in instead of Black Creek, who was a manager that had been in the portfolio for a number of years. And that was really based on a view that there were some succession issues with the departure in the Black Creek team, and we could take the advantage of bringing in one of our favoured managers that weren't currently in the portfolio that looked quite similar, but were at a different stage of their evolution. And so there's just an example of how we will make changes to the manager lineup if we think there's a more attractive proposition out there. Now, looking at the portfolio in a bit more depth outside of just the manager lineup, this is what it looks like from a top-down perspective. And the simple answer is it looks like the benchmark. So we purposely want stock selection to drive everything. So from a top-down perspective, it looks top left as though there's no real style biases. There aren't. We do that by design. Bottom left, it looks as though there aren't big sector bets. Again, that's by design. And bottom right, there aren't big country positions relative to the benchmark. What we're trying to do is make stock selection drive everything. And so that's what you can see here. The portfolio looks very different to the benchmark when you look at it from a stock selection perspective. Some of you may have heard of the term active money or active share. It's a measure of how different the portfolio looks to the benchmark. We're up at about 75% active share. That is high for a single manager approach. It's very, very high for a multi-manager approach. And that means 75% of the portfolio is different to that of the benchmark. So that's why you can outperform by a considerable margin, despite looking quite similar to the benchmark at a top-down perspective. You can see here the big positions in the portfolio. Some of those are underweights. We're particularly underweight Apple, Nvidia, Tesla in the Magnificent Seven, also Broadcom and JP Morgan Chase at this particular point in time. And then in the overweights, there's quite a mix of financials, healthcare stocks, and other types of organization in there. Now, we often get asked about the Magnificent Seven, so I will touch on that. The first thing to say is that, we think they are great companies. We own most of them. We have nothing now. I mean, in the previous slide, we had a small allocation to Apple. We no longer have that and haven't for most of the 8 years we've been running it. So we've got 0 in Apple and 0 in Tesla, but we've got a position in all of the other 5. But we are overall significantly underweight the Magnificent Seven. We're about 9% underweight. We weren't. We were actually overweight Nvidia, for example, but following very strong outperformance, we're now underweight most of the Magnificent Seven, with the primary exception of Amazon, where we're significantly overweight. But we get asked about it a lot, and our view is that we have seen some extreme moves. You've now got a situation where 3 companies make up a larger market cap than all of those countries' stock markets on the left put together. That's something that we question whether that valuation is quite right, and we use this phrase here that it took Warren Buffett and 60 years to create $1 trillion of value in Berkshire Hathaway. Nvidia added $1 trillion in 6 weeks. So quite a lot going on in that space, and we just remind people that this is not the first time we've had highly concentrated markets with a small number of companies dominating. That has been true in the past, particularly in the 70s. But what is interesting to note is that the top 10 stocks at the end of each decade very rarely look like the top 10 stocks at the end of the next decade. And so we're always wary of some of these very large positions in the index. I'll just finish quickly on performance of the trust. Like other global equity funds, absolute returns have been excellent. And relative to others in the global equity sector, performance looks good on both a return and risk-adjusted return basis over 3 and 5 years, as we've shown on here. The detail is in the next slide. It's been a tougher period to beat the index. It's been one of the best performing portfolios on the planet because of that concentration in a small number of stocks. We've been similar to the benchmark over the very long term, very significant outperformance of the peer group, be that 6% per annum versus other global equity investment trusts, be that 4% per annum relative to the wider peer group, including open-ended funds. But we do try and look at it a bit differently. And so what we show here is how much of our returns versus that of the index have come from calling the fundamentals of the businesses that we own correctly. In other words, have they been delivering more earnings than the market anticipated, versus how much has just come from multiple expansion of the companies, in other words, the sentiment in the market. And what it shows is that over any period you want to look at, our stock pickers have been doing exactly what we asked them to do, and that's finding companies that are delivering more than expected. It just hasn't always come through in all the share prices yet, because the market has really been focusing on a very narrow part of that market. So final slide is just an outlook from here. There are clearly lots of macro risks out there. There's a lot going on just in the last few days with what's going on in the US. In particular, equity markets don't look particularly cheap, and so we're cautiously optimistic, and actually our current gearing in the trust is a little bit lower than our normal strategic position because of that. But we're incredibly excited bottom up on the portfolio, because there's a lot of companies that we look at that are delivering terrific returns for their shareholders, but that in terms of what their long-term earnings growth are, but it hasn't yet necessarily been fully reflected in those share prices. And so that gives us a lot of excitement about the returns from the portfolio from here. But at that point, I'll stop and hand over to Joe.
Thanks, Craig. I think some particularly interesting stats on the ability of top quartile single managers to outperform over time. We've had some questions, but just to say, if you do have any questions, please do put them in the Q&A box. So I'm going to start off with one on asset allocation, which you touched on in the presentation. So you talked about how you allocate to the stock pickers and how you rebalance it. But one of the questions was, do you have limits for the maximum or under or overweight versus a benchmark?
Yes, so you're right. We start with a principle of, you pick your 11 favoured managers, you give them roughly 9% each, and you're about there. You can start with that principle, but clearly some of the managers run higher risk portfolios than others. They'll go further down the cap spectrum, for example, or might be a lot more style biased. And so it's more a risk adjusted allocation that we think about. And then we're looking at what the overall portfolio looks like. And so it's again trying to make sure that the portfolio looks quite similar at a top down level as we've shown here. And so that warrants how much weighting we give to each of the managers. To answer the specific question as to whether there are exact overweights and underweights that we feel uncomfortable with, the answer is no, because it partly depends. You're more comfortable with your relative position in a very large country like the US versus a small emerging market and the like. So we tend to look at what the contribution of that position is as a proportion of the total risk that you're running, and always just making sure stock selection drives everything. But the simple answer is we worry about every risk position we're running, and that's the debate we have at each of our meetings.
Great, thank you. And another one around portfolio construction. So you mentioned earlier that your active share is around 75%. The question was, is there a limit on the size of each holding, and whether there's too many holdings and whether that could prevent significant outperformance and result in the portfolio trending to the benchmark?
Yeah, so in terms of maximum holding in a stock, we don't have a specific holding. Now, the reality is the managers would typically, none of the managers, the underlying stock pickers, would ever let the holding get more than about 8 or 9%. If you think they're holding typically 15 to 20 stocks, they tend to start with a roughly equal weighting position, but a bit like us when I was mentioning, you then risk adjust that. you might see some of them let their largest weighting run up to 7, 8, maybe in extremis 9%, but they wouldn't typically be getting more than that. So the only way you end up with a lot in an individual stock is if all of the managers are liking that stock at the same time. Now, we've got 11 managers. We've never had it. I think we've actually currently got one stock that 6 managers own, but that's the first time. It's typically never had more than 5 managers own the same stock. But let's take the extreme example. Let's say every single manager liked the same stock. You'd probably end up with about 5% in that stock. Well, bear in mind, Apple is about 4.5% in the index. So, a single manager portfolio would very often have 5% or more in its largest stock. So the most extreme scenario that's never happened, and I'm pretty sure never will, is not something that terrifies us. So we don't get too worried about that. Of the 200 stocks or so that we own, there's about 10 or 12 of them that are owned by 2 managers or more, and about 180 to 190 that are owned by only 1 manager. So we do end up with about 200 stocks. We think that is a very good diversified portfolio, but it looks very different to the benchmark because you've typically got, on average about 200 stocks with about 0.5% each, whereas the index got lots of stocks with about 0.05% each, and then a small number of stocks with a lot each. Ours is a much more similar weighting to our stocks than you would find in the benchmark.
Great, thanks for that. Unsurprisingly, we've had a few questions around the US. So first question, what are your views on the amount of the portfolio allocated to the US? Have you been looking to rotate to other markets? And within the US itself, have you increased your exposure to mid and small caps?
Yeah. So yes. So the benchmark in the US has got around 60% in the US. We are slightly underweight the US, but the reality is that we are mainly underweight the US because we're underweight the Magnificent Seven. So we're actually overweight the US X the Magnificent Seven. Interestingly, there's lots of talk about whether the US is expensive, the phenomenal performance it's had, all that kind of commentary. Interestingly, if you look at the US excluding those Magnificent Seven stocks, it's a very different beast. It has got very different valuations, had a different performance record and the like. And we are slightly overweight that space if you exclude the Magnificent Seven. In terms of the large cap, small cap piece, I mentioned earlier, we don't really have any style biases. The one structural bias that we do have is that we tend to be, on average, underweight the mega cap and very large cap, and overweight the sort of mid cap and lower end of what would be termed large cap. That is a bias we've always had. We always will have. If you ask people to just pick their 20 best ideas, on average, they're not going to be in the very largest stocks that by definition have been the ones that have gone up the most and are of course the most covered by the brokerage community as well. So we are more overweight mid cap than the mega cap, where we're underweight. And that has changed a little bit because we've become more underweight those Magnificent Seven companies in particular over the last 3 months or so.
Thanks. And a similar question on S&P 500 concentration risk. So one of the questions was 5 of your top 10 holdings are from the Magnificent Seven. Would we expect this concentration to change in the fund over time?
Yes. So if we go to perhaps this slide, yeah, just to be clear, the Apple, Nvidia, Tesla are not 3 of our largest holdings. They're 3 of our largest relative positions because they're underweight. So Amazon is the only stock from the Magnificent Seven that you'd be considering an overweight position here. Now, that's not to say we don't, so Microsoft and Meta, we're relatively neutral, and so they are still reasonably large holdings in the portfolio. But these are incredibly diversified businesses. They are high quality businesses. We are comfortable having them as reasonably large positions in the portfolio. But for the avoidance of doubt, we are far less concentrated than the index. So those Magnificent Seven stocks, I think as at the end of February, they're about 20% of the MSCI All Country World Index, a higher proportion of the S&P 500, probably nearer 30%. But relative to that 20%, we're about 11% in those stocks. So we're half the concentration in the Magnificent Seven than the index has got.
Thanks. Another question probably won't come as too much of a surprise, and that's around Trump 2.0. So 2 parts of the question: what changes to the portfolio have you made as a result of the re-election of Trump? And have you modelled the potential impact of tariffs, and how has this affected stock selection?
Yeah. So the simple answer is that the portfolio hasn't really changed much as a result of the election of Trump. Of course, the thing you're interested in is the impact on share prices, which often happen in advance of the event, given people's views of the probability of that event happening before it does. And so a lot of what we spent our time talking to the stock pickers about prior to the US election was which of their stocks they're comfortable with regardless of the presidential election outcome, which ones they're more comfortable with if it's a Democrat versus Republican win, how it would impact if it was a clean sweep versus a divided Congress and Senate. But all of those kind of questions we were having. The other big questions we were having with the stock pickers were around which of these stocks can continue to do well in a different inflationary environment to when they might have bought them. So what happens if inflation is sticky, if interest rates stay higher longer than perhaps is priced into the market? What would that mean for those companies? We spent a lot of time digging into those kind of questions. The stock pickers made a few changes in their portfolio, don't get me wrong, but in the majority of cases, because we're picking long-term stock pickers, not people that are taking big top-down approaches, and because they're only picking highly concentrated 10, 20 stock portfolios, they're typically investing in stocks that they're comfortable they would want to hold for the next 5, 10 years, almost regardless of the economic and government regime in place at the time. Now, I don't want to completely dismiss the fact that tariffs and the like have bigger impact on certain types of companies than others, and we're discussing all of those with the stock pickers, but it honestly hasn't led to a lot of change in the portfolio. What leads more to change in the portfolio is if you see big price movements in the companies that they're investing in, and then they're quite happy to take profits on stocks that have done particularly well, and or buy into stocks that they think are great companies, but they haven't been holding because they looked expensive, but now they've fallen, they suddenly look more attractive.
Right, I think we've got time for 2 or 3 more questions. One was around anti-obesity drugs. So you have exposure to Eli Lilly and Novo Nordisk. Do you continue to see growth potential as anti-obesity drugs evolve over time?
Yeah, Novo Nordisk is an interesting one because that was a stock that was actually probably of our overweight stocks, that was the one that had the most negative impact on 2024 performance. Again, none of our stocks are massive holdings. We have it such that no one stock is going to make or break the portfolio, but that was the one that was the biggest. And people that have been paying attention to Novo Nordisk, they had some trials on some of their drugs that were came out a bit less positive than the market was expecting on the trial, and so there was a fall in the share price at in the second half of 2024. our stock pickers that were holding Novo Nordisk actually saw that as an opportunity to add. So we actually have increased the position in Novo Nordisk on a long-term basis. They think there's massive growth potential in that space, and that Novo Nordisk is going to be a winner in that. So they actually just saw that as a great opportunity to add to the position.
Great, thank you. There's been two questions around dividends, so I'll try and put them together. The first part of the question was, some of your peers have introduced targeted dividends. Are there any plans to change the dividend policy? And another question along the same lines, referencing JP Morgan Global Growth and Income paying a dividend yield of about 4% compared to about 2% for yourselves, and any kind of thoughts on the difference in that?
Yes, so JGGI are in the income sector, and so they are certainly part of their approach is to pay a high dividend. Ours is around that we will continue with this idea of an increasing dividend year on year. We've done it 58 years in a row. We're not going to be the ones that break that if we can help it. So we're more focused on ensuring that, as you say, our dividend is around 2% on the portfolio at the moment. Over the long term, our paid dividend is pretty consistent with what the yield is in our portfolio. Obviously, others, some of those in the income sector, pay out a lot more in dividends than they're actually receiving on the yield on the portfolio. We could do that. We've got huge reserves, but at this stage, I mean, that's a question for the board, but at this stage, comfortable with continuing the dividend policy as it stands, which is to increase that year on year.
Great. Two final questions, if we may. The first one is around turnover. So what is portfolio turnover and your average holding period?
Yes, so portfolio turnover does depend each year on how many changes we've made to the managers. So the underlying managers, their stock turnover ranges from about 30 to 60% typically. So they've got a typical time horizon of holding the stocks of about 2 to 3 years. Now they're tending to look further out than that when they're thinking about stocks, but when you've got quite volatile markets, you're actually seeing some of the things that they're wanting to play out quicker than they thought. So typically it's been around 2 to 3 year holding period for the underlying managers. Of course, turnover is higher when we, for whatever reason, make changes to those stock pickers, because you are going to sell the stocks that they had to buy a whole new portfolio for a new manager. There might be some overlaps. You wouldn't necessarily be selling all of them and buying all new ones, but generally you would be doing that. So 2024 would have seen higher turnover than is typical. We had the transaction with Witan in October. And then we also changed two managers. I mentioned EdgePoint coming in for Black Creek. And then in the first half of 2024, we had Arga coming in for Jupiter. And anyone that knows Ben Whitmore will know that he left Jupiter. And so we made that change back then. So the turnover on the overall portfolio in 2024 was closer to 100% last year, but that's relatively unusual.
Thank you. And one final question for you. What are your views on the Saba campaign and the implications for the wider trust sector?
Yeah, I mean, it's an interesting one. I think Saba have, without going into the specifics of the 7 that they were looking at and the specifics of exactly what their rhetoric was around it, they've certainly highlighted some important points, which is that some investment trusts are being managed better than others for the interests of shareholders. We actually look at Alliance Witan and think that it's been in a really good place. We've got a much lower discount than the rest of the global equity sector. That discount has been incredibly stable over the 8 years that we've been managing the trust. We have been growing the trust both through performance, but also with the Witan transaction, such that we've been able to get the OCR, the costs on the trust, to continue to reduce. And so, we look at it and think that Alliance Witan's incredibly well placed relative to all the things that have been talked about in the sector. But there's no doubt that there will be continued activity in this sector. There probably are a lot of trusts that are very small that are going to be increasingly difficult to justify their place with the costs that they're running. It's not cheap running an investment trust. You do need a reasonable amount of scale. So we think that we're actually well placed to help the industry in all of the things that it needs to do over the course of the next few years.
Great, thank you. And that seems a very positive note on which to end proceedings today. So thanks to Craig for joining us. Very interesting update, both on the trust and also your thoughts on the wider market. Just to say, we'll be putting a recording of this webinar together with the slides on the Kepler website. I can also recommend having a read of the excellent insight articles on Alliance Witan's website too. And on that note, thank you very much for joining us today, and we hope you join us again soon for another of our ISA event webinars.